On today's show, how differing forms of income correlate on a 1040, but not life insurance. Part 3 of this week's series, Life Insurance for Tax-Free Income, with our co-host and nationally recognized insurance product expert, Mike McGlothlin. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician and Newsmark. Let's get down to business. Well, welcome to the show, Mike.
Good to be back.
Good to have you back. And day 3, I mean, we're talking about things that matter. The first thing I want to talk about when today's show is we're talking about how income actually correlates on a 1040. I'm amazed when we go through this how many people just go blank on this. And so I want to really talk about why this works. In fact, actually, before we do that, let's go to the actual tax bracket. This is off Backroom Technician, and I'm looking at the effective, well, actually, the marginal tax brackets. And how do I know this phrase? Everybody says, Steve, you always use this phrase, effective tax bracket. Well, I need to see my deductions, my exemptions, my tax credits, look at my adjusted gross income, and I'm sorry to bring this up, then I have to go to page 2 to look at my modified adjusted gross income, which, Mike, there's about 6 or 7 different formulas for that. Yeah. How confusing is that?
That is very confusing. And when you talk about effective tax rate, you have a progressive tax system here that everyone gets stuck at saying, oh, my tax bracket's 35. Well, you have all these different calculations, and modified endowment may push you to a different, modified adjusted gross income may push you to a different level. So you really have to be careful where you're doing in conjunction with all of your other income sources, whether they're passive or active.
Yeah, I want to look at your true adjusted gross income from last year and your modified adjusted gross income, kind of see what the differences are and what's wreaking havoc on the modified side of that equation. Once I find out my blended or effective tax bracket after I've taken my deductions, my exemptions, whatever I'm legally allowed to credit back, I want to look at that number, and now I have a pretty good idea what I'm paying in taxes. Because I need to know that bracket if I'm going to play in any area of the ordinary income tax game.
And don't forget about state. This is just federal.
Oh yeah, this is just federal.
You've got the same thing on a state basis that have to be evaluated.
Yeah, and you should go out to the website. If you're operating in a couple states, you need to have everybody's state income tax too. And where I live here in Arizona, it's way different than where you live in Indiana. So it matters to really look through this. Now let's go back and walk through some of the basics. Now people say, Steve, and again, I'm trying to only talk about basic issues here. I can micromanage this on passive income all day, but I don't really want to go down that road. Ordinary income tax. Now, Mike, one of the big issues is if we didn't keep this policy in force, we would have an ordinary income tax on all the policy loans of gain. And whatever year that lapsed, whether it was terminated or performance caused it or surrendered, whatever the reason, if it was lapsed, then that ordinary income tax in that year for the full amount of the policy loans. How critical is this?
Yeah, and you hit the nail on the head with the full amount. Any loans that you've taken out over 20 years, that all gets rolled back up and counted into that 1 year. So you look at your progressive tax rates that we just had up, that easily can throw you up 2 different tax brackets with a stroke of a pen by having a lapse. So you really have to make sure that this policy stays in effect and that you manage it appropriately.
Again, I can't stress annual reviews and an in-force ledger. You can measure this and see the impact of this. You can see this coming years out. But for most of us who are reducing the death benefit as much as we can along the way at the front end of the design, as well as along the way we can manage it, you shouldn't have a problem. But if you did have a problem, the secondary issue is phantom income tax. Remember, is anybody paying the annual interest on these contracts?
No, it's kind of rolling up in one of those hidden things that can come up and bite you years down the road. So you need to be aware of the phantom part of it.
It can, listen, most people are not paying their annual interest charges, whatever they are. They could be zero net cost loans, very small, all the way up to direct recognition loans, which could be maybe 3.5, maybe 400 basis points, really, when you think about it. Phantom income tax, that means that all the loans on the inside of the contract that you never took constructive receipt, they also come due at the time of lapse or surrender. So it's really critical to keep the policy in force and understand the language in the contract on maturity date and the endowment phraseology that it uses to make sure you keep the contract in force. Capital gain. Now, everybody's going to say, well, why should I do this? My capital gain is only 15%. But is it?
Yeah, is it? One, it changes. It's a moving target. I think that the average tax rate change happens every 1.7 years. And then the other thing is because of the turnover, like we talked about yesterday, a lot of the gain inside of mutual funds ends up being ordinary income tax, this top level here, because they're so actively managed. a lot of those stocks inside that mutual fund are only being held for less than 12 months, so it becomes ordinary income tax because it passes through to the actual investor.
And remember, keep in mind, if you're a retiree or almost at retirement, you could have a capital gain tax of 15%. But that's just the tax on the gain. The full amount of the gain gets transferred over to the provisional income test, where they're going to test for Social Security whether it's taxed or not. That to me is a huge issue, because now you have a capital gain treatment that's actually causing an ordinary income tax event. It's correlated to Social Security. All these, by the way, are correlated to Social Security, so it's an issue. Mike, a lot of people buy municipal bonds, and they buy them because of one reason and one reason only.
It's tax-free.
I don't want to pay taxes.
I don't want to pay tax.
That's
but
right.
The reality is there's so many preferential items that get added back to the alternative minimum tax at certain levels. You're running both the AMT and your regular 1040, and whichever comes out higher, you're responsible for. So be really cognizant of how much tax-free that you're loading up inside of your 1040, because that may be pulled back under a different alternative minimum tax.
And be advised that even a private municipal bond, some of them are subject to the AMT because of the preferential treatment of it. But on top of that, that income still goes over to Social Security. So now all of a sudden, I thought what I thought was tax-free, I might actually wind up paying an AMT tax, and it may actually tax my Social Security benefits. Huge issue to keep in mind. We always talk about life insurance being tax-free, withdrawals to basis of policy loans, but I want to talk about the correlation of all these other investments and the impact. When you start putting this impact, we look pretty good at distribution.
Absolutely.
Talk about Social Security benefit tax. I mean, here, remember back in the day, and we still have information on this, we were told this will never be taxed. Well, now they have two-tier tax. One of them is pretty punitive. You're upstairs at the 85% level. Mike, they're already talking about maybe even taking your Social Security if you're a high affluent person, doesn't matter if you contributed or not. Taxes are going up, and this could be an issue, especially if you lost your spouse during retirement.
Yeah, and I think that this is Social Security in general is one of the most misunderstood elections for most Americans. This is a decision that can impact $100,000 to $125,000 of an asset, basically. So making sure that you do the right election and making sure that you do it in time, in the proper time frame of all your other distribution options between 62 and 70, that's going to be critical in the decision-making process. That 10-year period between 60 and 70, as you're transitioning from wage earner to depletion of your assets, that is critical. If you get out of the gate properly, you have a better chance of success. But if you mess those first 10 years up, it's a very, very quick downward spiral.
Well, keep in mind, again, the reason why we're showing all this is so that you can see the true value of tax-free against all these other correlated assets. When we come back from the break, we're going to continue. We're going to look at a little bit of Social Security and the actual provisional income test. People always ask me, I've never seen this before, Steve. We have it from Backroom Technician. We'll bring it to you right after the break. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. Of course, my co-host, Mike McGlothlin, we're doing kind of co-podiating here. And this is the venerated provisional income test. Taxation on whether you find out your Social Security benefits are going to be actually taxed or no. Mike, walk us through this single page here.
Well, in typical Social Security format, it's a 17-step calculation in terms of figuring out how much of your Social Security actually gets taxed. But we're starting out at 50% of your Social Security benefits in essence. That's one thing that I think a lot of Americans think, hey, I've worked all these years, I'm going to get these things back, I'm going to get them back tax-free. The reality is right from the very beginning, 50% of it's thrown into the calculation. We take a look at modified adjusted gross income, and we talked about a lot of different variations of AGI and those types of things. We're adding in some tax-exempt interest. We talked about how many people like to use municipal bonds for their tax-free nature, but that impacts this particular calculation and adds in to your quote-unquote taxable income from a Social Security benefit standpoint. We talk about the first tier threshold, and then we multiply that by 50%. That is the amount that's subject to tax, the smaller of those two. Now, when you get to provisional income here, we're talking about a second tier of threshold. At the end of the day, if you are married filing jointly, which most Americans, if your first tier is $32,000 and between $44,000, you're going to have approximately 50% of that benefit tax. If you're over that dollar amount, about 85% of your benefit becomes taxable.
In your tax bracket.
In your tax bracket.
Right.
And when you think about stacking, we talked about marginal tax rates, and then all of a sudden you throw in 85% of your $25,000 Social Security tax, that gets stacked at basically your highest marginal tax bracket because it's a progressive tax system.
So think about it. When everything we said in the first segment, a lot of this correlates to this page. I want to know the total effect of whatever product I'm buying. Not going to be much of an effect if you bought a reverse mortgage. It's a loan. Roth IRAs, they're not included in this. But what isn't, but life insurance that's TAMRA compliant is now adding on to another layer of tax-free that has nothing to do with this correlation. So
does not impact this at all.
Does not impact. And this is why I want to really make this important. I want to know the net effect. We always talk about fee drag and other things, but we kind of forget about not only regular taxation, but also Social Security benefit taxation. Now, I want to kind of go down our line of thinking here. Again, we're talking about life insurance product, and when we're looking at it, I'm looking at the actual tax here. We say no ordinary income tax. So if we keep the policy in force for the life of the insured, there will be no ordinary income tax because it's a non-modified endowment from the design, and we've kept it in force for the life of the contract. We've been very studious about when we take out withdrawals to basis, complying with the force-out rule during the first 15 years of a contract. So we shouldn't have to have either ordinary income tax or phantom income tax. We don't have capital gain tax. And people say, well, Steve, why are you going through this? Because I just went through why everybody else winds up on your 1040 and your Social Security tax and provisional income test. These are really important items that I want you to bring up. Any final notes in speaking about these things, because we don't have any of this on our plate. It doesn't wind up on the 1040.
Yeah. I always tell clients it's not what you earn, it's what you keep. And when you're talking about distribution planning, you need to figure out what is your after-tax disposable income. All these things have some type of impact, whether hard taxation or kind of hidden taxation with the Social Security benefit. You have to take a look at a planner about what does that client have in their pocket after everything's done on an apples-to-apples basis.
I think this is important to always compare the full 1040, and that's why I like doing Quicken Loans, or you can use your own. And I like to say, what impact? And you talked about something in the first segment about the difference, that real, what we call the in-between, really I would call tough period. I'm coming out of wage earning somewhere in my 60s. I'm ready not to take RMDs until I'm 70. I'm going to wait on Social Security maybe. That little in-between time is really where you're going to find yourself probably spending more than you thought you had. You're not really ready for coming online with Social Security in your retirement. So all these things of taxation really matter. You need to keep as much money as you can. It's your money. You should be able to keep as much of your hard-earned money as you can. And I think one of the alternatives looking at life insurance is, in this regard, shows you bottom line that this. But we haven't even talked about qualified plans. We're going to talk about that tomorrow. Well, that's all the time we have today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just hop out to our site, downtobusiness.ashbrokerage.com. Want to email me? Steve@downtobusiness.tv. And remember, you could be wiser as an Ash Brokerage advisor.